Welcome to Financial Revelations. I am David Safransky, your host. I'm your host every week. There'll never be another host. Well, I'm hesitant to say never or always. You never say those things because then it's bound to happen. But it's highly unlikely that I'll have another host. I can't get anybody to do it, really. That's the only reason. We're here every week. We try to be here every week. You can hear me every week on WCRF 103.3 in Cleveland, Thursdays, 8 a.m. to 9 a.m. You can also go to Moody Radio's app and listen no matter where you're at in the country. And now, even if you're on a plane, they have internet on planes. Delta is going to provide free internet for everybody on the plane starting like last week. And even if you're on a plane, there's no excuse to miss this broadcast or WCRF on Thursday mornings. You can hear it live on the app. And of course, if you have questions that you'd like us to answer on the podcast, you can email Corey, K-O-R-Y, Corey at EPSF.com. And you can call here 1-800-344-2534. 1-800-344-2534. Those numbers will be up somewhere around me. I asked Corey not to put the numbers on my forehead. I know that there's a lot of real estate there, but it's not appropriate, Corey. Stop doing that. One of the things that we're going to talk about today, and we're going to talk about this until April, I just know it, is the Federal Reserve. The Federal Reserve will be a topic until April, and I'll tell you why, because January of this year, January 31st, February 1st, they have a meeting. And I think that they're going to raise rates 0.5% or 50 bips for my friend Kathy. She likes to say, bips, because I say it here. 50 basis points or 0.5% on February 1st. They're going to continue to raise rates. I think they're also going to raise rates in March 0.25%, and then April 0.25%. So that's going to put the Federal Reserve's rate, what I call their reset rate, at 5%. They might go to 5.25%, but I think it's 5%, and then they're going to stop. And what they do, what I like to call the reset rate, is the rate at which they think, the Federal Reserve, the rate at which the Federal Reserve thinks we'll get unemployment to about 4.5% to, somewhere in between 4.5% to 5%. And there's a reason for that. And I know we don't want people to be unemployed, but I also don't want to have to pay somebody $23 an hour to work at Wendy's and give them a signing bonus. It's not tenable. It really makes everything inflationary. It makes everything more expensive when you got to pay a teenager $22 an hour, $23 an hour to flip a hamburger and empty a garbage can. It's not really a good thing. So that reset rate is kind of their shock rate. It's where they're going to go to because I think then in 2024, they're going to come back and they're going to set their rate at what they call their terminal rate, or where they want to keep it long term. And I think that's closer to 4%, 4.25%. And that's where they want rates to be. I like to brag to people that I have a mortgage at 2.65, and I feel like I'm stealing from the bank. And I'm not. There's no theft involved, of course. We would never do that. But in a way, it's so low. You can't really keep rates there. And what happens is when you have rates at 0% or really low like that for long periods of time, you get investments like Bitcoin. You get investments like NFTs. Do you remember the non-fungible token market? I'm old enough to remember when it was. It was a year ago. And you could get a picture of an ape for $2 million. Well, that picture of the ape for $2 million that people bought 18 months ago is now selling for $50. So when rates come up, capital redeploys, and it comes out of those things, those highly levered, those highly risky things, and it moves into normal things. And the bond market is going to be one of those normal things it moves into. And I think the Fed does want to take some money out of the stock market, move it over to the bond market. And I do think that you're going to get a pretty good quality corporate bond this year in the mid sevens. I mean, there's company bonds. I'm always hesitant to mention a name because people run out and buy that stuff. And before you act on my advice, you should talk to somebody. You should talk to a financial advisor. So make sure it's right for you. And one of the things I'm going to go over today is some of the classic mistakes that individual investors make when they're running their own money, especially after a bad year. I'll go over those, and I see these frequently. So this is not something that I guess about. This is something that I run into all the time. And so the Fed's going to bring that bond market back into play. Some money's going to come out of the stock market. It's already happening. I'm doing it. A lot of advisors are doing it. And so the Fed is going to be kind of the first thing we talk about now until April, I'm pretty sure. And then the other thing, at the end of the year, the last 3 days of the trading year and the first 2 days of the new trading year, that it's called the Santa Claus Rally. If you have a positive last 3 plus 2 new days of the new year and they're positive, that's a Santa Claus Rally. And then the first full week of the market, if that's positive, if both were, that's really a good sign for markets. I don't know why it is, but it is. The data will prove you out that if you have a nice Santa Claus rally, even if it's just marginally positive, in the first week of the new year, even if it's just marginally positive, you're probably going to have a pretty good year. And we had both of those things. We had a positive Santa Claus rally, and we had the first week of the market year was positive. So those are good things and good signs for the markets. And markets are low. Now, it doesn't, just because markets are low doesn't mean they can't go lower. But there is opportunity in the market right now. It's undeniable. If you think about, so if you have money in the market, you want the market to go higher. I understand that. I have money in the market. I want it to go higher. But if you have new money into the market, you want the markets to be lower. So one of the lessons that I learned in 2008 is that it is really good if you could just wait it out sometimes. And I think now is a good time to wait it out if you have money in the market. I don't think that that 2022 will be anything more than a bad year in 5 years. And when you look at things kind of in perspective, so it's hard, I don't really look at 1 year at a time. I want to put that into 5 or 7 or 10 years at a time. Where in 2022, if you put that in a 10-year time frame, it wasn't great, but it's not that important. And I don't think we'll be talking about 2022 in 5 years. We don't even really talk about 2008 anymore in the industry. We look back at it sometimes, and when there's an anniversary, we'll look at it. And 2008 was really bad, but the market lows were in March of 2009. It was all up from there. And I don't know that that's going to happen here, but I do think that there are some really nice opportunities in the market right now. There are some things that are working, and we want to find those things. What are those things? Excuse me. I have a doctor's appointment tomorrow for my little cough. I think it's going to be cured. Got sick in November. It's never gone away. It's really annoying, but it's probably more annoying for the people around me. And I talk a lot. Even when I'm not talking on this, I'm talking a lot. So it is problematic. But so we come out of 2022. A lot of people had a bad year. We didn't have a great year. In fact, we had a bad year. Worst year since 2008. But here are some of the classic mistakes people who run their own money. And sometimes when I'm running their money, they're trying to get me to do these things. And I have to say, no, we're not doing it. I'm not going to do that. If you're going to keep your money here, I'm the boss. And yes, you have a lot of say in what happens. But if you're going to keep your money here, I'm going to basically do it my way. Because if you were so smart, you wouldn't have your money here. So the first thing is over concentration. And I see this a lot when we get a new portfolio in where there's 30 or 40% in one thing. Maybe it might be one stock. And that's scary to me because I don't do that with my own money. I certainly can't do it with your money. And if we have 30 or 40% in one stock, you better know something that I don't. I mean, you better have inside information on that stock. You better be Paul Pelosi on that stock because it is just too much risk in one place. I can't do that. And I have had this happen where as money was coming over and I knew we had to unload some of that something bad happened in that market or that company specifically, and now we're stuck. We're stuck. Now we got to wait it out. And I don't like to do those things. Remember, I don't want to have more risk than what I need to have. I don't want to take any more risk than I need to take to get the rate of return that I want to get. So if you tell me, well, I want income, income's very important to me. I'm not putting more than 10% in one stock, let alone 30%. The other thing that people do, the next thing that people do when they run their own money is they have a bad year and they like, well, now I got to be more risky to make up for what I didn't get last year. And that is a fallacy. That's false. That is not the way to manage money. You don't up your risk just because you had a bad year. You go back to your plan, and that assumes that you have a plan. We're going to talk about that too. But doubling down on risk to make up for last year is not the way to do it. In fact, it's the opposite of the way to do it. And you don't want to double down on risk. You want to set up your portfolio so it has a certain risk profile in mind and then keep it there. Because a lot of times the things that didn't perform last year are going to perform this year, and the things that did perform last year are not going to perform this year. Energy is a good example. I don't know what energy markets are going to do. I think oil's going higher. China's coming back online. The one-trick pony of the Strategic Petroleum Reserve is over. They have to refill it now. I think energy prices are going higher. It's January, but the coldest months of the winter are still to happen. I think it's going to be more expensive. So don't double down on risk just because you had a bad year. That's mistake number 2. The third thing that people do is they're just too risky in general. Too risky. They don't understand risk and its impact. You see a lot of people with these leveraged ETFs now, 2 times, 3 times, 4 times leveraged ETFs. So if the market goes up, you go up 4 times. But if the market goes down, you go down 4 times. And those things they're really designed to be owned on a daily basis. They're not long-term investments. I don't really use them here because I don't like them. And you have to be super, super active in the market to take advantage of them. And I just don't like that type of investing. So too risky in general. They're trying to make a killing. They're trying to do a one-off. People will call me and say, is there something you got that can make me 12% in the next couple of months? And I'll say, I don't. But if you have something, would you let me know? The other thing that people do is because they're so afraid of risk, they don't understand it. They're too conservative in general. And that's mistake number 4. Being too conservative feels good because you don't generally lose principal. But at the same time, over long periods of time, you don't make money either. And so the market kind of passes you by. We saw that a lot after 2008 when people could not get back in the market, and the market did pass them by. And then now we're stuck looking for an entry point. So you don't want to be too conservative. Again, you want to have a risk profile in mind. The S&P 500 is really, we look at that as kind of the gold standard of risk. If you're riskier than that, and it's okay if you're a little bit riskier than that. It's also okay if you're a little bit more conservative than that, but have a risk profile in mind. We can help you quantify those things. A lot of times, people who do their own investing, they don't know how to do that. They don't know how to quantify risk in general. And because of that, they either miss out on opportunities or they're too aggressive and they get burned in the opportunities they think they have. Mistake number 5 is not having a plan. So what do? You come in and out of the market, you look for the hot buy, you read a money magazine type of thing, or you subscribe to a newsletter they don't know anything about you. And what I think about investing is there's a lot of good robo-investing places, and you could call some great, like Fidelity and TD Ameritrade and Vanguard. You could call those. They're not going to find out about who you are and what you need. They're going to say, well, here's some good investments that we have. And those are, if you just look at them as one-offs, they are probably good investments, but they might not be right for you. And that's what I think about investing is a very personal process. It's a very personal process. What do you need? And that's why I like working with the person or working with a company that's going to find out about you. You know, what is it that you're trying to achieve with these investments? Is a kid going to college? Is this a retirement home? What is this? What is the label that we're putting on this so we can help you do that? Some people just want to make money, and that's okay. And by the way, it's okay to be a more conservative investor. There's nothing wrong with that. You're not a bad person. It's also okay to be a more aggressive investor. Nothing wrong with that either, but understand what that means so that you could take advantage of it and not get burned. A lot of people, if they don't have a plan, they'll buy Bitcoin. They'll buy a little bit of this, a little bit of that, a little bit of this. And when they come in with their portfolio, I say, hey, just out of curiosity, why did you buy that? They'll say, well, I don't remember. That's a very common answer to the investments that are in somebody's personal portfolio that they're doing. Well, it's not my answer. I want to have a reason we bought that. Well, we're trying to be defensive against this other holding, and that's why we have that, because if that performs, this might not perform as well, but if that doesn't perform, this will. So we're trying to balance out those risks. So over-concentration, upping risk to make up for a loss, buying too risky in general, buying too conservative in general, and not having a plan. Those are the 5 things that I see most often. That's why it pays to sit down with somebody. Even if you don't use them to do your investing, you can pay them to set up a plan, and then you could go do it. There's nothing wrong with that. But find out, have a plan, know the mathematical calculations that identify risk in your portfolio so that you could have a good sense of how much risk you are taking. As always, we are always here. If you have a question, you can call us, you can email us. We love to answer questions on the podcast that people have, because if you're asking it, a lot of people are asking it. Well, I'm going to take that back. I haven't even said it yet, but there are dumb questions. But we won't call you out for them. Corey and I will just laugh about it. But it's not personal. I am David Safransky. This is Financial Revelations. I'm a real American and the voice you can trust.